Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. So let's first check what happened overnight. And European shares closing at their highest levels in 6 weeks, led by resources stocks, with investors buoyed by the promise of renewed China stimulus. On Wall Street, investors considered incoming US inflation data. Tech stocks drove the main indices lower there, with 8 out of the 11 S&P sectors losing ground. Nvidia fell after China's market regulator launched an investigation into the chipmaker over suspected violation of its anti-monopoly law. Advanced Micro Devices fell heavily after Bank of America analysts downgraded the stock, which weighed on the Philly Semiconductor Index. And Comcast shares plummeted after forecasting a loss of more than 100,000 broadband subscribers in the fourth quarter. Hershey surged on reports that Cadbury parent Mondelez is exploring an acquisition of the chocolate maker. And US traded shares of Chinese companies rallied after China's Politburo was quoted as saying it will adopt an appropriately loose monetary policy next year, which would be the first easing of its stance in some 14 years, along with more fiscal stimulus to boost economic growth. So that saw Alibaba, JD, PDD Holdings jump, while shares of EV firms, Li Auto, NIO and Zepeng accelerated, along with gaming stocks including Bilibili and Baidu. And the prospect of more China stimulus boosted US-listed shares of BHP and Rio, which reflected rising copper and iron ore prices. And shares of the gold miners rose as bullion prices hit 2-week highs. And Rupert Murdoch has failed in his bid to change his family trust to consolidate control of his News Corp media empire in the hands of his son Lachlan, with the US court ruling that he had acted in bad faith. Well, China is expected to adopt an appropriately loose monetary policy next year. That's according to top Communist Party officials ahead of the annual Central Economic Work Conference. Reports indicate that fiscal measures will focus on expanding domestic demand and boosting consumption. Meanwhile, in the US, the New York Fed's measure of consumer inflation expectations has edged higher to 3%. This comes ahead of the CPI data due out on Thursday. And Fed officials are now in a blackout period ahead of next week's policy meeting. US Treasury yields have risen as traders wait on the inflation data for clues about the Fed's interest rate decision. A 10-year was last up about 4 basis points to 4.19% and a 2-year at 4.12. And the US dollar slightly firmer. The Aussie and Kiwi dollars rallying on news of China's plans for monetary policy in 2025. The Aussie at 64.4 US cents. And Bitcoin has pulled back as the $100,000 level continues to be a major point of resistance. Well, taking a look at commodities, and oil prices have risen as traders consider China's stimulus and the fall of the Syrian regime led by President Bashar al-Assad. Brent crude futures about 1.5% higher at $72 a barrel. Copper prices up a similar amount. Iron ore 2.2% higher, $105 a tonne. And gold up around 1% to $2,658 an ounce, hitting a 2-week high on renewed buying by China's central bank following a 6-month hiatus. So let's get the perspective stateside now. Steve Sosnick joining us from Interactive Brokers. Steve, terrific to catch up with you again. I was just making the point that I haven't spoken to you since prior to the election, so just a little bit has happened since that time, of course, over the past month. Let's look most immediately what happened in the session just gone, losing a bit of that momentum. Why do you think you actually finished in the red?
Morning, Andrew. It's great to see you again. It's hard to put like a single cause on it. I think it was just a bit of profit taking. I mean, we were certainly due. We've pretty much been going up unimpeded, I'm going to say largely since the election, but particularly in the last few sessions. I think Friday we had a very glass half full read on the jobs report. I think today there was a little more sober analysis of it, saying that, yes, while the payroll numbers were strong, I think on Friday they focused more on the unemployment rate going up. But when you look at that, that's largely because the labor force participation rate fell. Some of that could be attributed to the fact that people are making money in Bitcoin and stocks, and so they're able to walk away from their jobs and not seek new ones. So it was more of a mixed report, I think, than it led on. I think we're going to still get some back and forth about whether the meeting on December 18th, the FOMC meeting on December 18th, will be in play or not. Markets certainly seem to believe that the preponderance of the likelihood is toward a rate cut. Powell pushed back, let's say, not on the December rate cut, but on future rate cuts when he spoke last week. So I think it's just sort of throw in some throw in some profit taking in Bitcoin, as you mentioned, because of resistance. Throw in some bad news on Nvidia because, not so much that it's the one specific thing between China and Nvidia, but this could be just the latest salvo in what we're going to have for a back and forth, a set of agitation going forward. So just I think it was more of a breather day. Markets don't always go up. They do go down sometimes, and this was a reminder that it does happen, and you don't always need a strong reason for it to occur.
So, Steve, clearly the next set of major data is that inflation data out on Thursday, with the market looking perhaps for another rate cut, as you say. But would it be fair to say that perhaps investors less focused now on the Fed and more focused on Donald Trump's policies, particularly those tax cuts that are to come?
I think that is fair. I think, to some extent, the market, when given a choice between focusing on the economy and focusing on the Fed, we have sort of opted toward focusing on the economy. And right now, president-elect or former president or incoming president, there's many ways you could refer to him, President Trump, is in a honeymoon period, because right now people are very focused on the potential benefits, deregulation, the easier drilling, potential for more M&A activity, no shortage of potential positives, and really not looking toward the potential negatives. I mean, tariffs are inflationary. If they go through their plans to, rescind the immigration status of people, I don't really know how you replace, thousands or millions of workers, potentially low wage workers. Cutting government jobs is, in the short term, probably not all that helpful. These are all things that have been out there. But we don't know what he's going to do exactly until he takes office, which will be January 20th, which, by the way, is a market holiday here in the US. It's Martin Luther King Day. So you could have a very interesting reaction the day after the inauguration, depending on what happens, because tariffs don't require legislation. They can be done by executive order. We'll see what other executive orders come out. But right now, when you think about how the market responded to the addition of Canada to the potential tariff list. He'd been after Mexico and China for years, in terms of they're I won't go into all the details. They're out there. But then he threw Canada in there, which prompted Prime Minister Trudeau to take a quick flight to Florida to talk things over. But the market reaction was, see, these are all negotiating tactics, and I guess for now you can perceive them as such. But of course, you can't have a successful negotiating tactic if you don't actually follow through some of the times. So I think right now we're very much in the honeymoon period. We'll see if that lasts once things persist. But you've got 6 weeks more of the honeymoon, and very, very strong momentum. So I think that tends to be the path of least resistance, at least between now, certainly in the end of the year, barring any surprises from the CPI or the Fed, and then into early January when we have to really start reassessing things.
Okay, so make the most of it. What do you make of the valuations then at the moment that's been priced in, particularly as earnings growth looking forward? Steve?
Valuations are borderline insane. I mean, they're not, but here's the problem. Valuation is a terrible timing indicator. Think of who the greatest value investor the world has ever known is, Warren Buffett. He's moved largely into cash. That might be a little tell that at least from a valuation point of view, he seems to be a little happier getting 4% nominal, 1 or 1.5% real interest rates, just by being essentially one of the world's largest holders of treasury products anywhere. But in general, what we've started to see is, the volatility has been record lows in terms of at money volatility for the S&P 500. Historical volatility is very low. But what we've also seen is relatively relatively high pricing. This is on a relative basis for for protective puts, 10% out of the money puts, whether it's 1 month, whether it's 3 months, the kind of stuff that someone might use as insurance. Now, I called these Schrodinger's puts because at the same time they're the most expensive they've been compared to at money volatility in years. But at the same time, on an absolute level, they're not particularly expensive. So it's telling me that there's either some residual demand for insurance, or at least those who provide the insurance are not really eager to part with it at current, at current low volatility levels. So there is some residual concern out there, but from a valuation point of view, valuation is taking really a backseat momentum. It's a trader's market, not an investor's market, certainly.
So your view then, perhaps all that good news is priced in, and maybe and then some. Is it wise to be just a little cautious at this point?
Like I said, I think it's relative. You know, it. I wrote a piece recently called "Don't Fight the Tape, but Insure Against It," saying that this is you don't want to stand in the way of the freight train, but sometimes the best time to buy umbrellas is during a drought. The price of those umbrellas, you could buy them relatively cheaply because nobody wants them. Then as soon as the rain clouds appear, at least I don't know how it is in Sydney, but in New York, you just add water and the umbrella sellers come out of nowhere. It's like you sprinkle water on the ground and they appear. And that's because they can get good prices for them. So that's kind of the same mentality with options right now. As I look at it going forward, when I hear about all the positive price targets for 2025, one of the arguments that I hear a lot is, well, we're expecting 15% earnings growth into 2025. Well, if everybody's expecting 15% earnings growth, that means it's priced in the market already. So to me, that's no longer a piece of good news. Certainly not bad news by any means. But let's say GDP is likely to come in 2.5 to 3%. Actually, the Atlanta Fed's GDP now model has 3.3% for the coming quarter, which is quite strong. So you figure 3% real GDP growth. Let's say inflation comes in 2 to 3%. You're talking 5-6% nominal growth, maybe. Well, where does the other 9% come from? So that's where the trick comes in, because you've got this extra growth priced in. Some of it really can be, the ingenuity of corporate management. And I've always said it's an easy way to go broke if you bet against, the long run ingenuity of good company managements. But this is why you see stocks really take it on the chin when they come up even the slightest bit light on their guidance or their revenues, most notably Oracle after the close, which was selling off on numbers that really didn't look particularly bad.
Well, Steve, I've got that umbrella metaphor stuck in my head now. That's a great way to sum it up. Thanks so much for joining us from Interactive Brokers.
My pleasure, Andrew. Talk again. See ya.
Quick check of where we're likely to open, and look, very flat at this point. SPY futures up just 2 points. So I'm going to get right across that when we come back in a couple of minutes for the open.